It was pleasing this year to see there was a lot less about superannuation in the budget, and most of the measures affecting the budget from a super point of view are to do with affordable housing. Rest welcomes the initiatives in the budget to allow first home buyers to use their super to get a deposit on a home. After all, having a roof over your head in retirement is very important. However, there are pros and cons to the initiatives, which are mainly designed to ensure that you can save for a deposit in a tax advantage way and also get a higher interest rate than you would from saving in a bank account. From 1 July 2017, you'll be able to make additional voluntary contributions, whether after tax or salary sacrifice, in order to save for a deposit. You can make contributions of up to $15,000 a year, up to a total of $30,000. Then from 1 July 2018, you can withdraw these contributions and earnings from your super to pay for the deposit. Any withdrawals will be taxed at your marginal tax rate plus the Medicare levy, less a 30% offset. But it's important to understand these rules only apply to additional voluntary contributions you make. They do not apply to the contributions that your employer makes to your superannuation account. So you do have to pay extra in order to save up for a deposit. Rest has questions over whether this proposal will make a genuine difference, particularly given the price of real estate. It's also of concern to us about whether low-income earners really have the spare cash to make these voluntary contributions to get into the home market. The Tax Office is still working through the finer details of these proposed changes, and we'll keep you updated. One of the main assets that older Australians have is the family home, and the federal budget recognises this. From 1 July 2018, if you're 65 or older, the government is proposing to allow you to make non-concessional or after-tax contributions of up to $300,000 into your super from the sale of the family home. This means that if you're part of a couple, you can both contribute $300,000 or a total of $600,000 from the sale of the home. The federal budget included over $70 billion in infrastructure over the next 10 years. At Rest, infrastructure is an important part of our investment strategy and helps produce strong long-term returns for your retirement. This has most recently been evidenced by our purchase, as part of a consortium, of the Endeavour Energy distribution business from the New South Wales State Government. Rest will keep you updated as these changes develop over the coming months. But if you've got any questions, get in contact with us and call our Rest Advice line, who can tell you how these changes will impact you personally. Well, I hope that information has helped. These changes are important because we know that housing affordability is a vital issue for the Australian community at large.